looking at the DXY breaking 100, it's a race to the bottom. Mm-hmm. I mean, basically, what of the major currencies, constituents of the DXY, would you buy or sell? It's immaterial. Really, what's happening is that the whole of the fiat currency system is coming to an end. And we're seeing evidence of this. Every fiat currency system comes to an end because of the accumulation of debt. And that's basically what we have at the moment, Danny. It's got to the point where it's not sustainable. If you look at what the US Treasury is doing, it's funding itself out of T-bills. It really is. The problem is there's no market on the long end of the yield curve. So they can't actually go out and replace maturing long-dated stock with more long-dated stock. In other words, ensuring that the annual rollover, if you like, of debt is contained. No, they're replacing long-dated with T-bills. I mean, that's where the market is. But what it does mean is, in effect, the US Treasury is printing money. I know it's using Fed dollars for it, but it's printing money because T-bills are near cash. If the other side of the balance sheet is near cash, then you can see what's happening. It's leading to a certain amount of liquidity problems, because if the government, if the Treasury doesn't spend this money, and at the moment, the major parts of the government are suspended, then it accumulates in the general account. So it goes out of circulation. So it doesn't go back into bank balance sheets, if you like. Mm-hmm. So on that basis, you can see that, this is tightening the system. On top of that, we had QT, which was also tightening the system. And this is why the Fed has stopped doing QT and will reintroduce from this month, next month, whenever, quantitative easing. But that again is printing money. So, we're on a printing credit roundabout now. How else can we print it? Well, let's find another way of doing it. That's where they are. And this is roughly where Germany was, I think, in the very early 20s, 21, early 22. And we know what then happened. And we can see how it's going to happen here too, because when the credit bubble bursts, and the credit bubble will burst, this is the biggest credit bubble in history. And on top of that, it's looking so much like 1929 with Trump's tariffs on top, replicating Smoot-Hawley and all the rest of it. When it bursts, what it's going to mean is that the Fed and the Treasury will stand by to rescue the entire banking system and also all the major zombie corporations in the US economy. They have to do it because the unemployment mandate, if you like. And of course, the Fed is also seeing in its beige book signs that the economy is falling over, toppling, if you like, stagnating, however you like to put it, turning down. So this is a time of maximum risk. Now, at the moment, I don't think that the stock market really realizes this, but there will come a point when it does. But for now, I think with extra QE coming in, the tightness in credit markets being alleviated, it could well feed into yet higher equities in the very short term, because what this credit has been doing is it's just been puffing up equity markets. It's been angled at financial markets. Just look at the level of margin debt. I mean, the level of margin debt is over 1.1 trillion, having risen over the last 10 years from about 300 billion. And that is financing stock positions. We can guess roughly 3 times that. So when this bubble pops, the banks will be foreclosing as quickly as they can, which of course will drive the market down even more rapidly. And the interesting thing is watching Bitcoin, because Bitcoin basically is a tech stock with no assets, no earnings, but just the vibes, if you like. And you can see that it correlates so closely with the Magnificent Seven. Magnificent Seven go up, it goes up. Magnificent Seven goes down, it goes down. So what's it doing now? I mean, Bitcoin basically is threatening to break out on the downside. It's dipped below its 250-day moving average, and I suspect that if it breaks that $100,000 level, you will see an avalanche of selling. There are an awful lot of people long of Bitcoin who are just in there for profits. I mean, we get from the sailors of this world this sort of wonderful stuff about how it's going to go to the moon and so on and so forth, but people are in it not because they think it's the new gold. I mean, that's That's for the fairies. They're in it basically because they want to make money, and they think it's an easy way of making money. You get this at the top of every credit bubble. And what the whole of the crypto market is telling us is just that. We are at the top of the bubble. And there's an awful lot of leverage in it too. And that, incidentally, is not in the FINRA statistics. I don't know how much leverage there is, but this is a global problem. Things are going to turn sour. Now, it's always impossible to pick the exact top in a credit bubble, and you can be wrong for 10, 15, 20% easily, even though you've analyzed it correctly. So I think I'm not prepared to say that we are actually at the top and all the rest of it, but I'm seeing a few things breaking down. And we know we've got the liquidity crunch, and we know that what the Fed is in effect doing is moving from targeting inflation to supporting the economy and ensuring that it's got enough liquidity. That is bound to undermine the purchasing power of the dollar. So, okay, it's 100, but also at the same time, this is the king rat of currencies. Other currencies are in exactly the same boat. It's just a question of who goes down fastest. And at the moment, it's not quite the dollar. The dollar might win that race to the bottom shortly afterwards. I don't know.
When you look at the US dollar index breaking below 100, you're not watching a story about one currency losing ground to another. You're watching the beginning of a global race to the bottom. None of the currencies inside that basket, the euro, the yen, the pound, the Swiss franc, is healthy. Asking which one you'd buy or sell is like asking which lifeboat on the Titanic you'd prefer after they've all sprung leaks. It's immaterial. The deeper truth is that the entire fiat currency system, the paper-based global monetary structure we've all taken for granted for 50 years, is coming apart. This isn't hyperbole, it's arithmetic. Every fiat system in history has died the same way, under the weight of its own debt. That's not ideology, it's simple mathematics. The system accumulates debt faster than the productive economy can support, interest payments compound, and eventually policymakers have only one option left: print. That's exactly where we are today. If you look at what the US Treasury is doing, the evidence is right in front of you. They're now funding themselves almost entirely through T-bills, short-term paper. That's never happened before at this scale. The long end of the yield curve is dead. There's no genuine demand for 10-year or 30-year bonds anymore. No pension fund or foreign central bank wants to lock up capital for a decade in exchange for a promise from a government drowning in deficits. So the Treasury has retreated to the short end. It's a liquidity shell game, robbing tomorrow to pay for today. And here's the danger. When you roll over trillions of dollars every few months, you're effectively operating a perpetual motion printing press. The government issues near cash, the Fed monetizes it with near zero maturity, and the illusion of funding continues. But the truth is, the Treasury is printing money under another name. We've reached the fund your government like a hedge fund stage of empire. It's unsustainable. Every T-bill issued creates more liquidity in the short term, but undermines long-term confidence. The moment investors doubt the rollover, the machine stops. There's another consequence to this funding structure that most people don't see. When the Treasury issues T-bills and then delays spending, for instance, when parts of the government shut down, that cash just sits in the Treasury's general account. It's out of circulation. It doesn't flow back into the banking system, so liquidity tightens. The system lurches between feast and famine. Add to that quantitative tightening, QT, which was meant to drain excess liquidity, but the Feds quietly abandoned QT because the consequences were too painful. They're preparing to reintroduce quantitative easing again. More bond purchases, more balance sheet expansion. QE is coming back not because they want to stimulate growth, but because they're trapped. We're on what I call the credit roundabout. The policymakers are going in circles, printing, tightening, printing again, hoping the centrifugal force will keep the car on the road. It won't. It's roughly where Germany found itself in 1921 and 1922, the early stages of Weimar. The debt was unpayable, the political system paralyzed, and the money printing disguised as support for the economy. By the time the bubble burst, the currency was worthless. Now, I'm not saying we're weeks away from wheelbarrows of dollars, but the parallels are impossible to ignore. The largest credit bubble in history is starting to shake. You can see it in the data. Margin debt, money borrowed to buy stocks, has exploded from $300 billion a decade ago to over $1.1 trillion today. That's what's been inflating the stock market. And when the bubble pops, that margin debt becomes the fuse that accelerates the implosion. People forget what margin debt really is. It's gasoline. It amplifies every move, up and down. When stocks fall, margin calls force selling, and the selling forces more selling. It's a self-feeding spiral. That's what happened in 1929, and it's what will happen again.
But the thing that's interesting is that these, with the system under strain, I guess this is why people like Jamie Dimon are saying gold's going higher, and why, Morgan Stanley sort of turn around and say you should, put 20% of your portfolio into gold. Now, that's an extreme statement. A very extreme statement. But I think that the really senior bankers see these dangers. They must be concerned about it. And I think that they would have told the Fed, look, you can't go on tightening like this. We're losing deposits which are going into the general account, and we're not seeing it come out the other side. We are under strain. You carry on this way, you're going to see the same sort of thing we had in September 2019. You may remember when the repo rate suddenly shot up to about 9%, and the Fed had to come in and sort it out. But we're not far from that sort of thing happening. I mean, it is tight, very, very tight. But where does this take us? Well, the thing that's absolutely clear is that if we can look through the top of the credit bubble, when it starts going down, Danny, you will see inevitably the duty, if you like, of the Fed and the US government basically is to keep the show on the road. And how did they do it? They would just accelerate the printing presses. What did they do in Germany in 1922? Accelerated the printing presses. We have exactly the same situation. And on top of that, we can superimpose our lessons from 1929 to 1932. The difference is that in those days, businesses went bust because the dollar was on a gold standard. And the only way in which credit got wiped out was by debtors going bankrupt. And the debtors included something like 10,000 banks. They went bust and didn't honor their deposits. Today, of course, you don't have that. So where is the strain? What happens? How do you reduce the amount of outstanding credit? Well, you don't reduce the amount of outstanding credit, but what you do is you reduce its value. Its value contracts, collapses even. And that's the way in which this is going to work. And the value of credit collapsing starts with the currencies. Currencies will go down. And unless the political class actually wake up to this, and unless their advisors get off all this macroeconomic rubbish and actually begin to apply proper classical economic lessons and inform the politicians of that reality, then there is no way that the fall in the purchasing power of these currencies is going to stop. That's what's required. We've got to go back onto a gold standard. In effect, do you see that? No, I don't see that. And I certainly don't think that 8,130 tons allegedly in the coffers of the US Treasury are there. I don't think they're there. I think there's a big shortfall. So you've got a credibility problem, which is being well aired, and it's well aired even by people like Scott Bessent. Guess what? As soon as he becomes Treasury Secretary and he gets his feet under the desk in the Treasury Department, what happens? He is told, don't say anything about gold. Stumm. Don't talk about it. Why? Well, I can see two reasons why. Firstly, they are in denial about gold because they have been promoting the dollar as gold's substitute, if you like. It's a dollar standard around the world. And the second thing is a lot of that gold, I think, went out. It was leased and never came back. You open Fort Knox, I think someone rather cleverly said, you find a whole bunch of IOUs sitting there.
We've reached a point where the global monetary order, the dollar, the euro, the yen, is like a three-legged stool with termites in every leg. The question isn't which leg breaks first. The question is when the whole thing collapses. People ask, will the dollar lose its reserve status? The answer is that it's already happening, slowly, quietly in the data. The share of global trade settled in dollars has been shrinking. BRICS nations are trading in local currencies. Central banks are buying gold at record levels, not treasuries. That's not politics, that's survival. The US has overplayed its hand. It weaponized the dollar, sanctions, tariffs, asset freezes, and in doing so, turned the world's reserve currency into a political tool. Once trust is lost, the privilege of being the reserve issuer starts to erode. Meanwhile, the treasury market, the backbone of the system, is becoming dysfunctional. There's no deep bid for long-duration debt anymore. Foreign demand is evaporating. Domestic institutions are saturated. So the Fed will step back in as the buyer of last resort, QE 5.0, QE 6.0, whatever label they choose. It's coming. But here's the paradox. Every new round of QE that saves the system also accelerates its destruction. It props up asset prices but undermines faith in the currency. It's a short-term political solution to a long-term mathematical problem. That's why I say this moment looks eerily like 1929. The structural setup is the same. Massive margin debt, concentration of wealth, speculative excess, and protectionist trade policy. Trump's tariffs are a modern replay of the Smoot-Hawley Act. They might feel patriotic, but they'll exacerbate global inefficiency and raise costs. That's exactly what happened a century ago. And just as in 1929, the credit bubble will burst. When it does, the policymakers will try to rescue everything, the banks, the corporations, even the equity market itself, through direct monetization. They'll succeed temporarily, but at the cost of the currency. In other words, inflation will come roaring back, but this time, it won't be cyclical. It'll be existential. You'll see the Fed's balance sheet expand in ways that will make the COVID stimulus look conservative. The Treasury will issue trillions in new short-term debt. The deficits will spiral, and the global confidence in the dollar will erode further, not because anyone wants it to, but because it can't be sustained. That's why gold is not just rising, it's repricing. The fiat system has reached its point of exhaustion. Every major economy is now in the same race to debase. The euro is collapsing under the weight of Southern Europe's debt. The yen has been devalued into oblivion. Even the Swiss franc is no longer a safe haven. It's a synchronized fall. The DXY index measures one sick currency against a basket of other sick currencies. It's like weighing one leper against another and arguing who's healthier. So yes, the dollar might win the race to the bottom. But that's not a victory. It's just the last man standing before the floor gives way. What does this mean for ordinary people? It means the purchasing power of every fiat currency is going to decline sharply in the years ahead. Food, energy, and tangible goods will become the true yardsticks of value. The middle class, whose savings are trapped in paper assets, will be hit hardest. That's why the smartest money in the world is already moving into tangible assets: gold, silver, land, and productive commodities. They're not waiting for CNBC to announce the end of fiat. They see the writing on the wall. Bitcoin enthusiasts will tell you their digital coin is the answer. But Bitcoin isn't a hedge against systemic collapse. It's a reflection of the same speculative psychology that created it. It's a high beta proxy for liquidity, not an anchor of stability. It moves in tandem with the NASDAQ, not opposite to it. When credit tightens, Bitcoin sinks. When QE returns, it rallies. That's not sound money. That's leverage sentiment. The difference with gold is profound. Gold doesn't rely on power grids, exchanges, or network validators. It's a 5,000-year-old constant. Central banks hold it for a reason. And unlike crypto, it can't be printed, duplicated, or rug pulled. Gold's recent breakout above 4,000 isn't just a rally. It's the market quietly announcing that trust in fiat is dying. Silver, too, will follow. The relative underperformance will reverse violently, as it always does near the end of monetary cycles. Now you might ask, what happens after fiat? That's the trillion-dollar question. My view is that we're moving toward a bifurcated world, one in which the Western Bloc clings to digital fiat systems, central bank digital currencies, or CBDCs, while the rest of the world re-anchors trade and settlement in real assets, primarily gold. The BRICS nations have already made that clear. They don't want a new currency. They want a new system, one where gold functions as the neutral arbiter of trust. The dollar won't vanish overnight, but its role will diminish, just as sterling did in the mid-20th century. When that happens, the average Westerner will experience what emerging market citizens have known for decades: the slow suffocation of purchasing power. You'll see stagflation morph into currency dislocation. Prices won't rise because goods are scarce. They'll rise because trust in money evaporates. And once that process begins, it's almost impossible to stop without a total reset. This is why central banks are buying gold quietly, while telling the public that inflation is under control. They understand that gold is the only asset that survives the transition between monetary eras. The tragedy is that most citizens won't see it until it's too late. They'll hold their wealth in bank accounts paying negative real rates, in government bonds guaranteed to lose value, and in stocks priced for perfection. That's why I say it, and I'll keep saying it, this is not a time for complacency. It's a time for preparation. Hold tangible assets. Minimize exposure to long-duration debt. Be skeptical of digital promises, because when the dust settles, history will repeat the same lesson it always has. Every fiat system ends, and every ending looks the same. Denial, panic, then gold.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.